Welcome to This Explainer. If you've ever just stared at your investment portfolio and felt like your stocks were kinda just sitting there, doing a whole lot of nothing, well, you are in exactly the right place. Today, we're diving into a really fascinating strategy that can actually turn those stagnant buy and hold stocks into active, income-generating machines. We're exploring something called covered calls, and surprisingly, we're gonna do it entirely without all that confusing financial speak.
All right, to really wrap our heads around how this works, let's actually step away from Wall Street for just a second. Imagine you own a beautiful rental house, and it is currently worth exactly $500,000. Out of nowhere, a potential buyer comes along. Now, they aren't ready to buy the house today, but instead, they make you a really unique offer. They offer to hand you instant cash, right here, right now, just for the legal right to buy your house for $550,000 at any point in the next month.
And get this, it's not some tiny conditional deposit. The buyer just hands you a completely non-refundable $5,000 in cash. No strings attached, simply for making a promise. All you have to do is agree that if they want to buy the house for $550,000 within the next 30 days, you'll sell it to them. And remember, your house is only worth $500,000 today.
Now, think about how this plays out. If they actually end up buying the house, you make a massive $50,000 profit on the sale, plus you keep that initial $5,000. And if they decide to just walk away and not buy it, well, you still keep the house and you still keep the $5,000. It sits right in your pocket. You keep the money no matter what happens. You'd take that deal in a heartbeat, right?
So why are we talking about real estate? Because that exact, absolute no-brainer scenario where you get paid cash today just for making a promise about an asset you already own is exactly how selling a covered call works in the stock market. It's the exact same mechanical framework, just applied to shares of a company instead of a piece of property.
Formally speaking, a covered call is just an income strategy. You use shares you already hold in your portfolio to collect instant cash. Now, in the financial world, they obviously don't call it an instant cash deposit, they call it a premium. But hey, don't let the word premium throw you off. It is literally just cash being dropped into your account today.
Let's translate some of that jargon into plain English, shall we? The covered part? That just means you own the underlying asset. Specifically, you own at least 100 shares of a stock. You're covered because if you're forced to sell, you already have the shares ready to hand over. Selling a call is simply you making that legal promise to sell those shares to someone else. And the strike price? Well, that's just the specific agreed-upon price you will sell at before a strict deadline. It's essentially your $550,000 house price, but for stocks. Okay, let's run a real-world simulation to see how this mechanically flows in your account. Step 1. Let's say you own 100 shares of XYZ tech stock. It's trading at $100 a share, meaning you've got a total investment of $10,000. Step 2. You decide to sell a covered call with a strict 1-month deadline and a $105 strike price. Step 3. In exchange for making that promise to sell at $105, a buyer in the market agrees to pay you a $2 per share premium.
Now, because one options contract in the stock market always, and I mean always, covers exactly 100 shares, that $2 premium multiplies out. That means you get $200 deposited right into your brokerage account today, not next month, today. Just like that non-refundable cash for the rental house, that $200 is yours to keep permanently.
Fast forward 1 month. The deadline hits. For all intents and purposes, we're basically looking at a fork in the road with two main paths this simulation can take. On one side, we have scenario A, where the stock stays below your $105 strike price. On the other side, scenario B, where the stock unexpectedly shoots up to $115. Let's explore exactly how you fare in each of these timelines.
Let's start with scenario A and see how this builds your income. The stock just kind of stays below 105. Maybe it drops slightly to 98, or maybe it just wiggled around to 102. Because it's actually cheaper to buy the stock on the open market than to use the contract to buy it from you at 105, the buyer simply walks away. In option speak, the contract expires worthless. And ironically, that is a fantastic outcome for you. You keep your original 100 shares, you keep the $200 cash premium, and the absolute best part, your obligation is gone. You can turn around and repeat this exact same process next month, generating another premium.
But what about scenario B? Say the stock shoots up to 115. Because the stock is absolutely soaring, the buyer definitely wants to buy it from you at the cheaper agreed-upon price. So you are forced to sell your 100 shares at the 105 strike price. But let's actually do the math on your return here. You bought in at 100 and sold at 105, meaning you make $500 in pure stock profit. Plus, you still get to keep that initial $200 cash premium. You walk away with a total profit of $700 in just 1 month on a $10,000 investment.
I know what you're thinking. Walking away with cash in both of these scenarios sounds incredibly enticing. It almost sounds like free money, right? But come on, we know the market rarely hands out free lunches. To be a smart, focused investor, you can't just look at the rosy outcomes. You need to be fully aware of the mechanics that work against you. So let's talk about the two major catches to this strategy.
Catch number 1. Your upside is strictly capped. Remember that strike price was $105? What if XYZ Tech releases some groundbreaking new product, pulls an NVIDIA, and the stock suddenly skyrockets to $150 a share? Well, a deal's a deal. You made a legal promise. You still have to sell your shares for $105. You completely miss out on all that extra profit above the strike price. Basically, you traded your limitless upside for that guaranteed $200 premium up front.
Catch number 2 goes in the other direction. You still have downside risk. A lot of folks think that selling options somehow magically insulates them from market volatility. It really doesn't. If the underlying company suffers a catastrophic earnings report or a market crash and the stock drops to $40 a share, you are still left holding those depreciating shares. Yes, you have that $200 premium in your pocket, but let's be honest, that provides only a tiny cushion against a massive drop in the stock's value.
So weighing this all out requires looking at the ultimate reward versus the inherent risk. The reward, generating reliable, repeatable income on stocks you plan to hold anyway. It literally turns a static portfolio into cash flow. But the risk is the opportunity cost. You are actively choosing to give up massive lottery ticket gains if the stock explodes upward. You're trading the possibility of a home run for the absolute certainty of a base hit.
Ultimately, this tells us exactly where this strategy belongs in your toolkit. Covered calls are incredibly useful, but they are specifically best utilized for stocks you expect to move sideways, or maybe just creep up slightly. If you own a mature, stable company that doesn't swing wildly in price, selling covered calls allows you to squeeze extra value out of it month after month, successfully converting a boring stock into a highly efficient, income-generating machine.
So now that you've got the core mechanics down, the real estate analogy, the math, and importantly, those capped upside risks, it's time to look at your own holdings. Open up your brokerage account mentally right now. Think about those stocks you've been holding for years that just kind of bounce around the exact same price point. Which stagnant stock in your portfolio are you going to use to collect your first premium? Thanks so much for joining me on this explainer, and hey, happy investing.